All right, so you'll see the live button on top, and I guess in a minute, we'll see people pop in.
Cool.
And I don't think you have access to see how many people are coming in.
Okay.
But I guess like if you ask, hey, like if, where's everybody from? Hopefully they will be able to respond on that box, and you have an idea like how many people are.
Cool.
Yeah.
All right. Yeah. No, I'm good. We'll give it a few minutes here. Let some people come in, hopefully, and
we got one right now that just came in.
Cool. All right. Yeah, everybody, we're just going to give it a couple minutes here before we get rocking and rolling. Let a couple more people start to join us. I appreciate you taking some time out of your busy Saturday to, come listen to me talk about ways to, leverage some money to get into some more deals. So we'll give it a couple more minutes here, and we'll start rocking.
So far, about 5 people.
Okay. Cool. All right. Again, thank you everybody for joining me. I'm gonna get started here in just a minute. Leave a couple more minutes for some stragglers here. We also may see my partner, Eric Mauz, jump in here. He's having some technical difficulties, so we'll see if he jumps in.
Nick, I'm on. Can you hear me?
I can hear you.
Okay, perfect.
Perfect.
Sorry about that.
No, you're good. All right,
hey, everyone.
So let's just let's kind of dive into it here. Eric, you see my screen okay?
I can see it, but it's cutting off some of the words on the left side. That's better.
All right, so we'll leave it like this, and we'll go through the presentation like this. That works. So again, thank you everybody for joining us. I'm Nick Diferedico with MB Capital Solutions. This is my partner, Eric Mauz. Today we're going to talk about, how we help real estate investors to leverage unsecured lines of credit and credit cards to fund more deals, take advantage of more opportunities. So we'll go through, exactly what unsecured funding is, ways that we acquire it, and more importantly, ways that we can leverage it and use it. So what we'll talk about today is, who really is MB Capital? Who are, what is it that we do? How do we help real estate investors, business owners all across the country be able to go out there and take advantage of more opportunities? We'll talk a little bit about the Funding Toolbox, which is the concept that we developed that, pretty much every real estate investor has, whether they realize it or not. And again, like I said, we'll talk about unsecured funding, the types, uses, and then at the end, save some time for some question and answer. So if you have any questions as we're going through anything, if you came here to get something answered and we don't touch on it, make sure you submit a question. We're happy to answer anything, as we're moving through it. So looking forward to this. So again, my name's Nick Diferedico. I'm the lead funding strategist here with MB Capital Solutions. What we help, like I mentioned, real estate investors, business owners on a daily basis get access to funds to make sure that they can go out there and take advantage of opportunities. So whether they're fix and flipping, buying, holding, wholesaling, whatever it is, working capital is necessary to have. So that's what we help with on a daily basis. I started out as actually a client of MB Capital's, Eric, about 10 years ago when I was in a different business, got me access to capital that I continue to use now in my real estate investing business as we're growing this lending company. So about 5 years ago, I saw the writing on the wall in my previous business and joined forces with Eric, and the rest is kind of history. So I owe a lot to Eric and the way he helped position me way back in another business to help kind of start that next business and keep things going.
Awesome. Thanks, Nick, for the intro. Hey guys, I'm Eric Mauz. I'm the owner of MB Capital and also a funding strategist on the team. My background is in the engineering world. I went to Drexel University, which is based in Philadelphia. But all along the way, since my senior year at Drexel, I've been investing in real estate. Picked up my first property with excess student loan money. So I definitely, from day one in the investing world, I've been creative. Figure out if there's a problem in front of me, figure out a way to solve it. And that's what we do here at MB from a credit and a capital standpoint. So I started to use the lines of credit in my business, my real estate business, in '08. Saw the value that it had for mine and my brother's business, got it off the ground, got it moving, portfolio properties. Since being introduced to this model in a quicker fashion than we would have without access. And in 2009, started to share these concepts with investors, with small business owners, so that they can, start to benefit from just having additional access for all the different ways we're going to talk about today to be able to, fund the deals and scale the business. So I'm excited to be able to spend 45 minutes with you. Want to thank, Nick Tang for putting this together. Definitely appreciate you continuing with the Expo, even though we're in a little bit of a different world today versus, 12 months ago.
Yeah, me and Eric were just talking a little bit ago offline that we miss going up to the event on a Saturday and getting that face-to-face interaction with, everybody coming by the table. So, definitely weird for this Expo, but definitely look forward to that next one where we can actually see everybody face-to-face. Sorry, you want to go over MB?
Yeah, so I already started sharing. MB was created back in '09, so that's when I started to help clients, real estate investors, small business owners nationwide, to start to get some access. Our office is located about 20 minutes east of Philadelphia, so we're down in South Jersey, out of Washington Township. And as we mentioned multiple times, we're going to help that small business owner and investor. At this point, we've helped over 1,700 clients get over $60 million of access to unsecured funding, and ultimately, it's all about building the right foundation so that for the long term, you're in a position to grow properly and grow the right way. I've seen a lot of webinars going on today where a lot of good content, and I'll be honest with you, a lot of it is. A few different people had talked about toolboxes as an investor. We're going to talk through the funding toolbox, but I thought it was pretty neat how they incorporate it, just making sure as an investor you have the right tools. Part of that is the lending side. Part of that is different people on your team, the right attorney. So our goal here is really to be that additional option to help position you for long-term success by having the right tools.
Yeah, and Eric mentioned it, the funding toolbox. The funding toolbox is a concept that we've sort of developed, after meeting with, thousands of real estate investors all across the country. The one thing that we learned is not everybody funds their deals the same way. And in that, we've also learned that people tend to get stuck in their own ways, right? Like if I fund a deal using my own cash and hard money, I kind of fall in love with that model, not realizing that there's other options in my toolbox that I may or may not have access to that will allow me to either better fund that deal or scale up and do more deals. So as you see here, this slide is really, all about the funding toolbox. Hopefully you've been on a bunch of the other webinars today. I've seen some really good hard money webinars, some private money webinars. The truth of the matter is, while some people like to think that they all compete for your business, the best way for you, the real estate investor or the entrepreneur, is to kind of leverage them together and learn how they complement each other to be able to take advantage of more opportunities. So we're going to just do a basic overview of the funding toolbox, but the things that we're seeing that the real estate investors are using are obviously residential, commercial loans, whether it's a conventional mortgage, a mortgage in the LLC name, or a long-term rental loan in the LLC name. We're going to need to leverage, residential and commercial loans here as we're starting to build our portfolio or scale our business.
Yeah, John Palumbo also talked about the home style. The home style loan that investors can use. He was talking about that, a few hours ago. So it's beyond, it's that residential side. There are some options for us investors to really to be strategic and save some money in terms of rates and fees.
Exactly. Yeah. I mean, if you can get that home style loan, where my understanding of it is, you're putting down a minimum payment, but they're also giving you some of that rehab funds. similar to like a 203K construction loan, that allows you to get into a deal, have the funds available to fix up, and then potentially refinance out at a higher value. Lines of credit we're going to talk about today. You'll hear a lot of investors talk about 401ks and self-directed. It's another tool in the toolbox. If you have an old 401k that's just sitting there, a lot of times if you roll it over to a self-directed IRA or another, type of fund like that, you can start to leverage that money into going and doing deals. Hard money is big for us real estate investors. They really shouldn't call it hard money. I always joke that it's pretty easy to get as long as the deal makes sense and you have some skin in the game. You're going to be able to get your deal funded. Credit cards is a way that tons of real estate investors get their deals funded, whether it's the purchase, rehab. We're going to go through that a little bit more in depth today. But credit cards are a must-have tool in your toolbox. A HELOC, a home equity line, if you have a primary residence that has enough equity built up into it, I'm a big believer in, yes, have the access through a home equity line. I think a home equity line should be used last in terms of the tools in your toolbox. You don't want to put your home at risk while you're taking advantage of an opportunity. But it is nice to have it there in case stuff pops up, and who wouldn't want the extra access. Personal loans, personal loans can come in very handy. I have a couple of real estate investors right now where personal loans are going to help, kind of save their deal. If you have W-2 income, let's leverage that to be able to go get you access to quick personal loans to either use as down payment funds or to help clean up credit to get you access to a larger line of credit. But a personal loan is a tool in the toolbox to be able to leverage and use. Cash, cash is king. We know that. I always like to talk about, holding on and hoarding cash. The one thing that we've learned is cash is the easiest thing to spend, and it's typically the first place people go when they have to spend money, right? Let's spend the cash. But we've learned if you can start to leverage all the other tools before using cash, you'll be in a much better position. Because most times, if you use up all your cash, you're not in a position to acquire any of the other tools. So let's acquire the other tools and hoard our cash, and then use our cash as our last resource.
Yeah, and even talking about cash, like right now with the interest rate environment being so low, it's very inefficient to not utilize other people's money across the board. So keep that cash in your pocket. We're in the middle of a pandemic. Cash is king. Cash can be used the same way that we're going to talk through utilizing the lines of credit and the credit cards for reserves, for emergencies, should things not go perfect on a project. So just keep that in mind. Let's be smart with the cash. Keep as much liquid that you can of your own cash, because there is a lost opportunity cost as well by putting that cash at work versus letting it sit there, and hopefully in a financial product that you can get some growth in and tax advantages.
Yeah. And then obviously private money is a big tool. The downside to private money is I see a lot of real estate investors, they fall in love with the thought of private money. They have a private money investor that's giving them funds, or they may have multiple. But we've seen it in the last 5 months, especially, in terms of how many clients me and Eric are talking to that had that private money lender, that now that private money lender is going in a different way, or COVID has them scared, so they're putting their money on the sideline. So the more you can have these tools built up, like we mentioned, it allows you to not miss a beat if one or multiple of them kind of fall off at some point. So Eric, what's an unsecured business line of credit?
Unsecured business line is exactly what it sounds like. It's a revolving line of credit that you can utilize without any collateral. So it's leveraging the strength of that personal credit to be able to get multiple lines of credit. Think of it like a personal credit card, right? A personal credit card. If you have a $20,000 limit, you can use any of that $20,000 all the way up to the limit. And once you start to pay it back, you can then re-access it. So on the business side, the idea is we're going to use that personal credit to be able to get funding under the business, so it never shows up on your personal credit. So it's a nice tool. They are personally guaranteed, but the lenders, even though it's under the business, the lenders are going to base their decision off of the strength of that personal credit. And then the type of lines which we'll get into will be dependent upon the age of the business to determine what actual type of lines of credit you can qualify for.
Yeah, in a nutshell, we're leveraging your personal credit to get you access to some lines of credit in the business name that you could go use for any general working capital purpose. So use it for that down payment, use it for the renovations, use it for marketing if you're out there wholesaling and you need to kind of drum up some properties. It's not deal specific. It doesn't have to be tied to a project. So it's a line of credit that you can tap into essentially for anything. So building business credit versus building access to cash inside your business. I talk a lot about this. There are other methods out there to kind of build up business credit. You see a lot of people pushing those types of models. Where we're a little bit different is we're not going to worry so much about building up your DMB score, your paydex score, or getting into, vendor trade lines, which I'm going to talk about here in a second. Our real goal in working with clients is get them access to cash now so they can go out there and take advantage of an opportunity. If you're a real estate investor, we don't have 6, 9, 12 months to start to build up and use accounts that we may not actually need for our business to be able to go out there and, get a business credit card when we can do that essentially day one. So, most of our focus is on helping you get access to cash to go out there and leverage to go and create more wealth with, more than it is just building up business credit. And what I mean by that is, you'll see a lot of different institutions pushing vendor lines, and vendor lines are exactly that. So they're credit cards or credit lines at a Staples, Grainger, Home Depot. They may or may not be non-recourse, but really the vendor lines are there to help build up your payment history within the business so that it helps build up your DMB and paydex score. The downside to those vendor lines is that you can only use them at those vendor locations. So having a $20,000 Staples credit card is great, but I can't use that $20,000 Staples credit card as down payment to go purchase a property.
Look, I'm pretty creative, right? I'm pretty creative when it comes to buying properties. I've never used a Staples trade line to fund one of my deals.
It'd be sweet if you could.
Absolutely.
And if you could, we would probably know about it by now. Unless you're going and buying reams of paper and selling it for less on the street to get the cash, you're not going to be able to use your Staples card, unfortunately, to go purchase a property. The Home Depot cards do come in handy if you're doing a rehab and you're buying the materials. Ideally, you want to get that vendor line in the business name, like I mentioned. But again, we're going to focus more on cash access lines of credit and not so much the net 30, 60, 90 days accounts. It's not something that we assist with our clients, but we're happy to point you in the right direction if that's what you're looking to do. But again, we're going to focus more on access to cash as opposed to just building up business credit. And in saying that, the lines of credit that we implement will naturally build up your business credit anyway. So that's why we focus on getting you cash access now. Go use it on a deal. It's naturally going to build up those DMB and paydex scores as a result of you going out there and doing deals. So vendor lines, not something that we help clients with, but we do like to educate on the difference between what we're looking to do versus some of that business building type of line of credit that we don't implement for clients.
This second type of line, we call it a checkbook line. Before I jump into that, just a reminder, if you have any questions, post them either in the Facebook chat. I do see Ronald, I saw you have a question about a lock. We will get to them. One other thing, I'd love to know where, we got over 20 people viewing. I'd love to know where you are, if you're scattered in New Jersey or somewhere else in, across the country. Love to know who we're speaking to, because we can help clients nationwide, and there's going to be different options based on where you are in the country. So a checkbook line of credit. So, I refer to this as a traditional line of credit. This is where you go out there and approach a bank and get a large, somewhere between $25,000 up to $250,000 or more in a line of credit where you have checkbook access. As you can see, there's two different types. The more traditional type is really in my eyes, the full doc. underwriting line of credit. So this is where you have an existing business. It's over 2 years. You have 300, 500, $1 million or more in gross revenue. And the bank is going to take all of that into consideration along with your personal credit to determine whether or not to approve you. So it's full doc. You're giving them everything. It's going to take anywhere from 1 month to 4 months for the bank to make a decision, depending on how many questions they have. And you'll typically get in that 10 to 15% range. So if you have $500,000 of revenue, you could get 50 to 75,000 through a bank. And there are competitive rates. It's going to be prime plus 0 to prime plus 4. It's tough for us as real estate investors to qualify for this one because our revenue, especially if you're in the rental world where it's passive income, banks don't consider really much of that passive income as actual business revenue. They're looking more for that active income, active revenue in whether it's a consulting business, a restaurant, a management business, where there's that revenue plays a bigger part for a bank making a decision versus someone who's either buying rentals or even fix and flips, because you can buy a house for you could sell a house for $1 million in a year and you technically have $1 million of gross revenue. One thing that is pretty common with this is the UCC filing. So for those who don't know what a UCC filing is, it's where a bank will put a lien against your business. And it's just a letter on file just showing that they're in first position and that, they have granted you access to a line of credit so that any bank who pulls your business credit afterwards can see it. We do know the lenders that will put the UCC on file, and we know the ones that don't put the UCC on file. So when we're building a plan for a client, it's all about strategy in, approaching those that don't put the UCC on file first, and then use that last lender option that puts the UCC on file so you can maximize your access. The streamlined line of credit is similar to the traditional line. The biggest difference is it's based on stated and projected income. The banks are not going to ask for tax returns. You're not going to have to provide 2 to 3 years of tax returns. Underwriting is much quicker. Pre-COVID, it was probably 7 to 10 days. Post-COVID, it's more 2 to 3 weeks, and every once in a while, a lender may go a full 30 days. And you'll get somewhere in that $25,000 to $100,000 range. Still competitive rates, prime plus 1 to 5. Prime right now is at 3.25. So you're still in that 4 to 9% range. And this model, once again, is also similar. Not every bank is going to put a UCC on file. So knowing the lenders is important when building a plan to get multiple lines of credit in place for a client and for a business owner.
Yeah, and great point there about the UCC. A lot of people don't think about the UCC. A lot of people don't know about the UCC filing, but it can make a huge difference as you're trying to build up the access in terms of lines of credit in your business name. I remember a client where he had a $15,000 line of credit with TD Bank. We'll just name them, right? They had a UCC filing on it, but that UCC filing allowed us to not move forward with getting him access to any other additional lines of credit. So what we're actually able to do is help him pay off that TD Bank line and close it. And then we're able to then go and open him 3 separate lines of credit, 2 for $50,000 a piece, and then a third one for $75,000. So $175,000 compared to the $15,000 line of credit with TD Bank, just by simply knowing the right lenders and how they're going to, work the product, is a big difference. So the UCC filing is huge, and most people don't know about it, and it can make a huge difference in how you're building up capital inside your business.
Before Nick jumps into the credit card model, one thing, there was a question around how long are these open? So these, the traditional lines of credit are typically reviewed at a certain period of time. Sometimes it can be within, 12-month review. So the banks will just do a 12-month review, take a look at credit real quick. But most right now that we're working with are doing a 2 or 3 year review before you have to renew it. So, but the idea is if your personal credit is positioned in a way where it's always strong because you're leveraging capital under the business, when that renewal period comes, it's not going to be an issue to get it renewed for another 2 to 3 years.
Yeah, great question. As long as you use it responsibly, it's not going to go anywhere. But it's a permanent line of credit that you're going to be able to keep tapping into. So the other option, and it's an option that we get calls about all the time, and it's a tool that we implement in a lot of real estate investors' toolbox, are credit cards. So exactly what it sounds like, a credit card. Ideally in the business name, but where we're a little bit different is we focus on credit cards that come with cash convertibility features. So liquidating a credit card into cash and being able to use it same as cash, but carry that debt on our credit line. Without doing cash advances. So cash advances are a very, very dirty word. Please don't say it around us. You're not, when you do a cash advance, you're paying high interest on it. You're not carrying the debt at a low interest rate. And it's just not advantageous for you. So we're going to show you 3 to 5 different strategies when you're a client and when we acquire credit cards for you to be able to liquidate into cash. And the best part of the credit card model is it can be a new or existing business. So even though you may be, have 2-3 years of history on your LLC, that's great. But even if it's a day or two old, we can get funding in that business name, leveraging a credit card. Best part, no financial documentation, no collateral needed. Based off of your personal credit, funds are issued inside the business name. And really the huge benefit of the credit card plan is not just the additional access to capital, but it's the 0% introductory rates. So right now on 0% credit cards, we're seeing anywhere from 6 to 18 months. There are some lenders that are doing a little bit more than that, but 0% interest, for anywhere from 6 to 18 months. So think about the ability to pull off your down payment money off of a credit card, use it with a hard money lender to essentially 100% fund a deal without having to use your own cash, and more importantly, carry that down payment money that you just took off of a credit card for up to a year and a half. Huge game changer. In addition to just acquiring their credit cards and showing you how to use it, one of the things that we do for clients on more of a consulting basis and working with us is coach you on how to use that initial 0% offer. But in addition to that, how to continue to get 0% offers coming to you after they expire. And what I mean by that is when you leverage the funds the right way, and for us as real estate investors, it's pretty easy because we're taking the funds off of the card, putting it into a deal that we're either going to flip or we're going to refinance within a year. We should be. So the funds are going to come back and allow us to pay that credit card back down before the 0% offer expires. When you're able to do that, it triggers the lender to give you another 0% offer. And they really do that for 2 reasons. One, they're a credit card company. They want to hold your debt. It looks good on their balance sheet. So when they find somebody who's used the money right, it incentivizes them to give you another 0% promotion. But the real reason why lenders do that is that they know that the statistics show that 91% of the people that use 0% promotions at some point screw it up. So they just assume, all right, this person used it right. Let me send them another 0% promotion because at some point I'm going to get interest on this person. We show our clients how to be part of that 9% that know how to use the 0% promotions the right way, but to have them keep coming. When COVID hit, I actually took a credit card that I've had for almost 10 years now, and I liquidated that credit card into $30,000 in cash. So, nobody knew what was going on with coronavirus or COVID. And before anything weird happened, I was able to liquidate cash into a bank account. Now,
Hey, Nick.
Yeah, Eric.
Good question came up, and I think it's good to talk through it here. Would you recommend waiting? At what point would you start to get the credit cards in place because of that 0%? Because you only have, time's ticking, right? You got 6 to 18 months. When do you recommend putting the credit card in place?
The second you're able to, because we've seen it with clients many times where they're trying to wait for the right opportunity, and then the right opportunity pops up, and now we got to scramble around to get the cards in place for them and show them how to start to liquidate the cards into cash. Whereas once you have the cards and we show you how to start liquidating into cash, typically you're going to be able to find that opportunity. And if some of the 0% offers are ending, we're going to strategically show you how to use the right ones first, so that you can keep extending that promotion. So I always say when you're in a position to do so, you get them put in place. That way that you have the cash behind you to be able to take advantage of that opportunity when it pops up. And even though some of the offers may start ticking, we're always going to show you ways to kind of, re-strategize or move debt around, so to speak, to be able to keep extending those 0% offers.
Nice. Yeah. Long term, I mean, we're coaching our clients how to stay between 5 and 10% on an average interest rate. So the 0% is great, but think about having that access. I had a client last week who I was talking to. We got him and his wife about $60,000. They put it into a deal right away. This was 18 months ago. I was talking to him last week, and he said he just picked up a property, bought it using the cards. It was a lower end. It was somewhere in that $30,000 to $40,000 purchase range, and he was able to, he told his wife, he goes, let's save this $25,000 card because we're going to use that for the renovations. So he's like, look, it's not 0% anymore, but here I am. I'm able to tap into it. I can get this project done over the next 30 days. It's a quick turnaround. Then he's going to flip it, and it's going to sell quick in his area, especially the way the market is right now with limited inventory. So he specifically told me, he's like, I would give a testimonial for you guys, no problem. Just saying, I'd much rather have that line in place well in advance versus find a deal and not be able to get it in place because of, the money came a day later, or the lines of credit got in place a week later. So just think about that. Think about the lost opportunities by not having, being in the right position prior to needing it. It's different than a loan. A loan, you get it when you need it. Lines of credit cards, you want to get it in place ahead of time so that when the opportunity comes, you can jump into it.
Yeah, exactly. It's always better to have the access, because typically I found, the best time to get access to funds is when you don't need it, because typically when you do need it, you can't get it for some reason. So if you're in a position to get it, I always say, let's get it implemented. This way it's in your back pocket. It's easier to pull the trigger. The one thing I do want to mention about the credit cards is, from a cash flow perspective, your minimum monthly payment when you're carrying 0% debt is only 1% of the balance. So use me for an example. That $30,000 that I put into a bank account, at the beginning of COVID, cost me $300 a month, and it's all going directly towards principal. So I'm actually using the cash that I put into the bank account to make that monthly payment. And if I don't use it in the next 9-10 months, I'll just pay the line of credit, the credit card back, wait for that another 0% offer to come. So like I said, I've had that card for almost 10 years, and like clockwork, they keep coming. So, credit cards, great tool to be able to go out there and leverage to get into more deals.
Are you talking through personal cards or business cards, or both right here?
So ideally, we want to be able to implement everything in the business name. For what we do, sometimes we strategically have to add in personal cards, because again, in working with the lenders nationwide, seeing how they're approving apps and knowing their products, sometimes we have to implement some personal cards to be able to kind of unlock the business products. So depending on each individual, how they're positioned credit-wise, their plan may vary. But usually we're adding in some personal cards to be able to start to unlock certain relationships so that we can start to build up additional business capital, leveraging that same lender.
Yeah, Ronald, you don't, when you tap into that personal, what you're affecting is not the debt to income ratio, but what's called the revolving credit utilization ratio. And that actually affects your score by up to 30%. So you want to be careful with how much you're tapping into on the personal side. So I'm not saying don't use it, right? Don't miss out on a deal because you got to tap into personal credit for a period of time. But we just want to make sure that we don't abuse it, especially for a long period of time. If you can stay under that, overall 30% utilization number, that would be ideal. Then not put yourself at risk for lenders lowering your personal credit limits, because that'll also have a negative effect on the credit.
Yeah. So block requirements, everybody always asks, what credit score do I need? I care more about credit data than just credit score. I know that 3-digit number is a living, breathing thing. And depending on where it's at, I can kind of manipulate credit to get the score where I need it. Where we care more about is the actual data. What's the age of your history of your credit file? How many inquiries have you had in the last 6 to 12 months? Is there derogatory information? Overall credit utilization, like Eric was just talking about with that question from Ronald. Typically we want to see that you're about 30% or under. How many current trade lines do you have? What are the limits in the history of those lines? So that's why I say data matters more than just score. I've had clients where they've had a 670 credit score where we've gotten more funding than that client with the 770 credit score, just because the data showed them to be a better risk. So typically we want to see around a 680 credit score, but I care more about just the data than the score. And like I mentioned, I would say about 80+% of the clients that we're working with across the country are real estate investors, and we're getting them access to these lines of credit cards for these types of uses. So gap funding, we may be using a hard money lender or private money lender, and we need that down payment, closing cost money. Let's hold on to our own cash and let's leverage a line of credit. Let's leverage a credit card. Rehab funds. I'll tell a lot of clients, leverage the credit cards or the lines of credit and front the rehab. Cut down on how much you're paying to the hard money lender and interest on the rehab funds. Cut down on draws. More importantly, keep your contractor moving. If you have a hard money lender who may be a little bit slower with inspections and draws, you don't lose a contractor to another job while they're waiting for you to get money. 100% finance a deal, which I'm actually going to show you a quick case study here. Holding costs, emergency funds, working capital in general. So lots of different uses for the funds. But again, it's all capital that we can use essentially for anything. So I'm going to show you now how a client has recently used unsecured capital to complete the BRRRR method. And in the same token, as you see how we've positioned her to handle the BRRRR method, she could have done the same thing and easily flipped the property. So I'm going to run you through a quick case study here before we start to wrap up and answer some questions. So this is a client that when we met her, she was looking to start a buy and hold rental portfolio. She had no cash, but she had some opportunities. She had high credit card debt. She was 65% utilized. Credit score was okay, 696, but with a brand new two-month-old LLC. She wasn't having any luck getting funding. She couldn't find a private lender, and most of the hard money lenders that she was talking to wouldn't approve her because the properties that she was looking for just had lower price points. She's in the Baltimore market, so much different than South Jersey, North Jersey in the prices that we see. But she just couldn't get approved for a hard money loan because the limits were just too low. So what we're able to do to get her into a position where we could start to acquire funding, we actually started with a personal loan. So we got her a $15,000 personal loan that we used to pay down all of her revolving debt so that we lowered her 65% utilization down to 14, and her credit score went up from a 696 to a 768. So quick debt maneuvering to get her into a position for funding. But we're able to, obviously get her that personal loan for $15,000. But in addition to that, we were able to acquire $86,000 in 0% credit card funding. In addition, we also acquired a $15,000 personal streamline line, prime plus 5, so 8.25%. So that is a personal line of credit, but it's an extra $15,000 worth of access that we actually use to pay off the personal loan. So she did have an opportunity in Maryland. The purchase was $27,000, rehab was $35K, ARV 120 on it. I know a lot of us are in Jersey right now. We're looking at those numbers, and we were wishing we had opportunity like that right now. Just a different market in Baltimore. But nonetheless, she has the access to be able to get into it. So how we were able to use the unsecured business lines to fund this opportunity for her was she actually used 0% credit cards to fund the full purchase and the closing cost. So we work with a third-party company that what they actually do is they take the agreement of sale as an invoice, and they will wire funds directly off of a credit card and wire it to the title company for a closing. So she was able to use all credit cards to purchase completely 100% this property, $29K, including the closing cost. direct wire transfer off of the cards to the title company. No crazy maneuvering, just showed up and closed. She then used the credit cards to also fund the rehab. So we showed her a couple different strategies to be able to pull cash off of the cards. But as well, her contractor did have a PayPal swiper and literally paid the contractor through PayPal. But the best part, 0% for the funding of the rehab. In addition to the purchase and the rehab that we've done at 0%, we actually showed her how to pull off the minimum monthly payments to make on the credit cards while she was doing the deal. So we pulled off another $8,000 that she just put into a bank account so she could service those minimum monthly payments to the hard money lender, to the 0% credit cards. So she didn't have to use her own cash flow or cash. She was able to fund this whole deal off of 0% credit cards. So all in, $74K, all sitting on 0% credit cards, which is beautiful. The exit strategy, again, she was building a buy and hold portfolio. She was doing the BRRRR method. So all in for $74K, ARV 120, got the property rented out for $1,100 a month, was able to cash out 70% LTV, so got an $84K cash out, 30-year fixed rate mortgage in the LLC name off of her personal credit, decent interest rate at 6.74%. So now she has a property that's cash flowing $500, and all of her credit cards have now been paid off with the cash out. So no balances on the credit cards. We have, cash flowing door, pumping out $500 to us. More importantly, we have the access to the funds to be able to go do that again. So we don't have to reacquire 0% credit cards, nothing like that. She can go use those same credit cards on the next opportunity. So for a client like that, she used $0 of her own cash to fund the acquisition and the rehab, leveraged all 0% credit cards, was able to obtain a cash out refinance and cashed out for $84K, rented out the property. She's got $450 coming to her in cash flow. Like I mentioned, was able to pay off all the credit card balances, and still had leftover from the refinance. Again, because, $74K all in, plus the $8K towards the debt servicing of it, she had an extra $18K in tax-free money just sitting there from the refinance.
And to be clear, just so you know, another good question. There's normally somewhere between a 1% to a 4% fee on turning the credit cards into cash, whether you're doing a balance transfer. Like our third party option, they're charging 2.5 or 2.75%. On average, you're in that 2.5-3% range when turning the cards into cash, to be able to strategically get them off the credit cards, put cash in the bank, and not pay cash advance rates.
Correct. So you're paying that upfront fee, it's just going on to the balance, and essentially the deal's paying it off anyway. So perfect, case study here, executed 100% flawlessly. She did a great job in rehabbing the property, following our guidance, but she was able to fund this whole entire deal off of 0% credit cards. So when people are out there and they're always like, yeah, I can't find an opportunity, or I just don't have the funds, there's always ways to creatively be able to take advantage of any opportunity that you find. So if you were interested in seeing how we can help you, we're going to post a couple comments here, but typically how we start with a client is we have an initial meeting where we're just spending time to learn a little bit more about you, find out what your goals are, short and long term, make sure that we're a good fit. Obviously, after that conversation, what we do is we take a look at credit. The one thing about us, though, is, as the strategist, we're very credit conscious. So we pre-qualify all of our clients off of a soft pull. So no hard inquiries, nothing like that, just to see how we can help you. After we take a look at credit, we'll have a full funding consultation where we'll walk you through step by step a game plan of what's available to you in the marketplace and how we can help you. And if you're ready to move forward from there, we take care of the funding implementation. If you were interested in scheduling an appointment, I know we're up against time here. But if you were interested in scheduling an appointment, you can follow this Calendly link, book a quick appointment on either my calendar or Eric's calendar, where we can have a little bit further of a conversation just to see how we can help you. Obviously, if you're on Facebook, which most of us are right now, type in MB Capitals, go like our page, and you'll get a lot more updates. We do a lot of webinars or different events, so go like the page, and you'll see more stuff from us. And now time for some questions.
Anyone out there have any questions for us regarding any of the case study or the types of lines of credit, or specific questions about you?
Ronald has a question. Do you know if every credit card company runs a hard inquiry pull when a credit limit increase is requested? It does vary. I always tell clients you want to call and ask them if you're going to request an increase, will they pull credit? They should let you know if they're going to pull credit right then or there. I'd rather you not have credit pulled for a limit increase, because most times, for a $2,500 or $5,000 limit increase, we could use that inquiry to go get you $10, $15, $20, $25,000. So it depends on how you're positioned, if it's worth it. But if you're going to ask for an increase, which I'm all on board with, I'd rather you do it without having them add an inquiry to your credit file.
So the question came up, how do we get paid? We're compensated on success and performance. And depending on the type of line of credit that you qualify for and that we get in place for you, you'll pay us a % of the approval amount. And that's a one-time fee. And then you'll be able to use those lines over and over again. We also have caps built in for the different models. So once again, it just depends upon the type of line. If we go out there and we don't get you any capital, you're not paying us a dime. It's all based on success.
Yeah, and I do want to point out, it's not like we take your credit file and go out there and shop like some of the other companies out there. When we take a look at how you're positioned credit-wise and business-wise, we already know the trends of the lenders, who's approved and who's not at the moment. So we create that custom game plan for every client. So every client's game plan is different. We're not just going down a list of lenders that we're just shopping credit to, because our goal is to get you the access to the capital, but keep you in a bankable, lendable position so that if you need to refinance, you can, or if you need it to acquire more capital in 3 to 6 months, you're still in a position to do so.
All right. If no other questions, we'll wrap it up here. And if anyone is interested in having a further conversation, we look forward to the opportunity to create value for you, and appreciate you all tuning in on a Saturday afternoon.
Yeah. Again, thanks, Nick Tang. Thanks for the whole crew putting on another great event. We appreciate it.